In this video, I will analyze the portfolio of a subscriber. You have somebody that sent me his portfolio and with specific picks, with some good information about his background, and I think we will analyze all the stocks he has in his portfolio. So that can be some good value for everybody watching this channel and for this person. In case this is your first video from this channel, welcome. This is not a review channel. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And the goal with this channel is to help you become a better investor. So I always welcome new picks, and this is also the reason why I'm doing this video, so that you can send me your portfolio and so everybody can benefit. Okay, let me read his email first, and then I will analyze the picks. Okay, so we have Lil Reba. Hi, I watch all your videos and you have been a massive inspiration for me in how I invest and look to study companies better day by day. Thank you very much. I would like to send you my portfolio to review in a video, and you can give me your background info. You have permission to show my numbers and be transparent and be completely honest, to flame me or make jokes or whatever you want. Well, it depends what you own. My real name is Gabriel Reberd, and I have been watching investing videos since I was 15. He is 22 years old. I like to invest in companies that have a high ROIC, share buybacks, revenue up and to the right, earnings per share up and to the right, preferably more than 10-12% annually. Okay, this is good, and this is what I preach on every one of my videos, to only invest in quality companies that are growing and profitable and returning capital to shareholders. So wonderful job, Gabriel. Disclaimer, I do use almost half of my account on margin, and many experts say not to use margin, for good reasons. I have found that effective use of margin can be a very smart thing if done correctly. Well, something tells me you are 22 years old. I hold cash to cover myself against a margin call, and my cash allows me to live my everyday life as normal while using borrowed money at 5% interest rates. So, okay. Fair enough. This is not the topic of this video, but always be careful, right? In case we have something bad happening to this market. Some of my positions are very right revenue growth, very high earnings per share forward growth, speculative plays in companies that maybe started to grow cycle. You have some speculative bets. I saw this. I skimmed through the companies you own. The majority of my holdings are in the quality compounder, okay, but we want other things. PayPal right now to me is like a bond position. Fair enough. I no longer like the company because PayPal has a declining moat. I couldn't agree more. Declining revenue, increased competition. Palantir is one of my holdings that grew so much that I'm willing to hold through this extremely high PE cycle. Now, spoiler alert for everyone watching this video, his biggest position is Palantir. So yeah, that's definitely a risk. As it is a company I'm willing to hold for many years, as the company is more predictable and earnings per share. Earnings are more predictable, blah, blah, blah. Tesla is another company that I bought at a more reasonable valuation. Fair enough. Long term, it's more speculation and quality. Other thing to mention, SPYU was an investment I made when the VIX was above 50 back. Yeah. Actually, he sent me this analysis in July, and since then, few things have changed. So now this is his portfolio at the left of the screen. You have AMD, PayPal, and SPYU that he sold, and this is the remaining part of his portfolio. So I'm guessing you, my audience on YouTube, watching this video, you own some of these picks. So you will have my opinion about these companies. Did I forget something? Did I forget anything else? So this is the portfolio. You have permission to say, to do or say whatever you want, or flame me or whatever. Keep up what you do. And guys, make sure, if you like this content, he has an investing coaching program. You will learn when to buy, when to sell, so that you can build a strong investing portfolio with great companies. This is free advertising. I take it. Thank you, Gabriel. Okay, so we have these great comments, and we have this portfolio here. this is a pretty large portfolio, I would say. How many picks do you have? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 1, 23 stocks. Fair enough. Fair enough. So why don't we start? We will start with the biggest companies in the portfolio. And I just created this Google sheet so that we arrange everything by percentage. And the biggest position, as he rightly said, is Palantir. We all know Palantir. We all know it's a growing business. We all know it's a business for the future. And we all know it's overvalued. So obviously, I don't like that you have Palantir as your biggest position. And the stock has gone up so much. Maybe it was not designed to be your biggest position, but because it has grown so much, it has become your biggest position. And I suppose most Palantir holders are exactly in the same situation. They bought a normal position and the stock went up so much that you have no choice but to grow the position over time. Year-to-date performance is 130%, which is absolutely crazy. And the company is firing on all cylinders. It's very sexy at the moment. People have forgotten all the risks, and the margins are high, and the valuation is just completely ludicrous. You have a forward PE ratio of 200. You can say whatever you want. It's the business of the future. They are getting more deals in the US, more deals in Europe. They will tap into the whole market. They have no competition whatsoever. The two guys running the shop are visionaries. You can say whatever you want. The valuation is just too high for what we preach on this channel. This is a momentum trade, right? This is a momentum investment. You have great growth. This is unbelievable, the kind of growth they have. But does it really deserve a PE ratio of 200? For my book, no. So good luck with that. But this is not the kind of things I would be comfortable buying in my portfolio. So obviously I don't like this being the first position. So apart from this, having 11% of your portfolio in one single position is okay. As your biggest position, I mean, now you are 22, so you can take a little bit more risk and have more concentration in your portfolio. What I like is you don't have a lot of cash. I didn't take the decimals here on these picks. So if you sum all these percentages, you come out to 98%, which means even if you round things up, you don't have much cash. This is great. As a 22-year-old, you can't have the luxury to have cash because you have so much time in front of you. It would be a mistake to hold cash. So congrats, man. That's a first good thing I have to say about your portfolio. No cash, minimal cash. Okay, so you have one bad thing with margin, one good thing with cash. We will see. For Amazon, you have Amazon as your second biggest position, 8% of your portfolio. I mean, I'm a shareholder of Amazon, so obviously I will like your investment. Amazon is a company with a lot of potential right now. Yes, it's big. Yes, it has a market cap of $2 trillion. But it's one of the few companies that can grow to $10 trillion in a few years. $5 trillion is easy for Amazon. Very easy for them. They are everywhere. And the highest margins segments are growing the most. If you look at all the segments from Amazon, you have Amazon growing very rapidly, 20% per year. You have the advertising segment growing very rapidly, very profitably. And overall, everything is lifting the profitability. So now Amazon is getting a lot of hate because of Andy Jassy, because the stock is not performing that well. On a year-to-date performance, the stock is up plus 5%. So it is dragging the S&P 500 and not following his brothers like Meta Platforms and Alphabet, Google. Well, if that's a reason to hate a stock, that's a great reason to hate a stock. I mean, as a shareholder, I love this reason. It means you can't hate on Amazon because the performance is great. Fundamentally, the business is growing very rapidly. Revenue is up, cash flows are up. They are investing in a new wave of innovation, and they are investing actually in two waves, AI and robotics. since 2020, they have not increased the number of employees, which is very good news from a shareholder's perspective. If I look at the financials for Amazon, let me go to Fiscal AI and navigate through the tabs so you can understand my point. If you go through the ratios, common size, no. Oh, they have changed this, so I think I can go to macro trends. Should be fine. Macro trends, Amazon. If you go to macro trends, this is a free website if you want to use it. You can go to other metrics, employee count, and this is what we have. Since 2020, 2021 here, no growth in employees. The growth has stopped for 4 years in a row. This exponential curve has stopped after COVID. And since then, revenue has improved. Look at this. This is your revenue over time. The profitability has improved. The efficiency has improved. So this is proof that the company can continue to grow without hiring new employees, which means the margins will go up. And it's exactly what we are seeing right now. If you look at the margins for Amazon, all-time highs. For the past 20 years, this is the operating margins for Amazon since 2005. Look at this. All-time highs now. And Andy Jassy want to squeeze all the juice you can get out of Amazon. Andy Jassy is the CEO of Amazon. The goal is to be efficient. The goal is to reward shareholders. And the goal is to be a leader in the next 2 waves of innovation. I think they will reach this goal. You never doubt Amazon. Doubting Amazon is a very good way of being disappointed, I would say. And if we have a changing environment with tariffs, for example, Amazon will still be here. If we have a challenging year with a recession, Amazon will still be here. You know why? Because Amazon services are great. AWS is great. The delivery is great. Amazon Prime is working properly. You have a business that is like an octopus being everywhere and could be a country in the future. This is so large, so big. I would see Amazon having $5 trillion in market cap in a few years, actually, without any doubt, as long as the company is growing. And now you can buy Amazon, I would say, at a reasonable valuation. If you look at the PE ratio for the business, where is the PE ratio? Here. This is your PE ratio over time. You have a PE ratio of 38 right now. Let me remove this because the company was not profitable because of big investments back then. This is the PE ratio of the business since 2024. And in April, it was trading at a PE ratio of 30. And actually, Bill Ackman, a legendary investor, bought Amazon during April. Bill Ackman, here we go. Bill Ackman added a new position into Amazon in April, and it is now 9% of his portfolio, exactly like you. So you have many super investors that are very concentrated in Amazon, and they see the potential. Out of all the super investors' picks, Amazon has a lot of concentration. Look at this, Alta Rock Partners, 25%. Josh Terasov focused on the moats, by the way, great investor, 20% of his portfolio. Value Act has multiplied the position by 6. It's 15% of his portfolio. Triple Front Partner, quality investing. Pollen Capital, quality investing, 10% of the portfolio. Bill Ackman again. David Tepper, 9% of his portfolio. You don't bet against these kind of people. And if they like to invest in Amazon with 10% of his portfolio, of their portfolio, it's actually very bullish. If you look at David Tepper, I mean, for those who don't know who David Tepper, you have great resources on the internet. It's a great investor, and he is, I would say, very successful and averaging a very good performance for the past 20 to 30 years. He made a fortune investing in companies that no one wanted to touch. and the third largest position in his portfolio is now Amazon, and he just recently added to the position. So we see the same things that some legendary investors are seeing. Additionally, if you want more resources on Amazon, you have the latest later from Bill Ackman, and it's great. Amazon will thrive regardless what. Regardless anything that can happen. Even tariffs will not impact Amazon that much. So in April, you had a PE ratio of 30. Now the stock has got up to a PE ratio of 38. That I think is deserved because of the quality of the business. Amazon is here and has definitely a long-term hold. What is unfortunate is for the past year, Amazon has underperformed the index. For the past 3 years, Amazon has underperformed. For the past 5 years since COVID, Amazon has underperformed. And the valuation has come down. So it's just a re-rating, a valuation issue. But I'm telling you this, if one day, for one specific quarter, the growth picks up again, Amazon will become a darling again, and Amazon will outperform everybody. Things go through cycles. Amazon is not the loved child for the moment, but this time will come. Next on the list, you have QLD. Actually, I don't know what QLD is, so it will be new for me. Also, it's just an index. Pro shares, ultra QQQ. Is it like leverage? 2 times leverage for the Nasdaq? I'm not sure, I guess so. Anyway, let me skip it. This is not a channel about ETFs. This is a channel about stock picking.
By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.
You have Lam Research. Oh, wonderful. Not a lot of people know Lam Research, actually. Not a lot of people are invested in Lam Research. I am invested in Lam Research. And this subscriber also is. So Lam Research is a great investment if you want to bet on AI and technology in the future, but you don't want to touch NVIDIA or AMD or ASML. You have the same category of an investment if you want to invest in semiconductors, chip with ASML, KLA Corp, Applied Materials, ASML, Tokyo Electron. All these kind of things are bets, investments in AI. And Lam Research is a great candidate to benefit from AI because the business is thriving and the valuation is reasonable. This is exactly our sweet spot, and this is also the reason why I personally bought Lam Research, and I am now up a lot on the stock. Let me read the description in case this is new for some people. Lam Research is one of the largest semiconductor wafer fabrication equipment manufacturers in the world. It specializes in deposition or an etch, which entail the buildup of layers on a semiconductor and the subsequent selective removal of patterns from each layer. Lam holds the top market share in etch and holds the clear second share in deposition. It is more exposed to memory chip makers for DRAM and NAND chips. It counts as top customers the largest chip makers in the world, including TSMC, Samsung, Intel, and Micron, as always the same big boys. You have a lot of exposure to China, obviously. There are some exposure to Taiwan, obviously, some Samsung, etc. as always. But let me show you the fundamentals of the business. The margins are extremely high and cyclical, obviously. And the revenue is up and to the right. You follow the cyclical nature of chips of this industry, but you have a business that is largely growing profitably without any debt issue. That is generating a lot of free cash flow. And what do they do with the free cash flow? They don't need to reinvest in heavy capex. They reward shareholders with buybacks. This is what I love about Lam Research. They deliver also with a small dividend of less than 1%. So 90% of the cash flows are used to reward shareholders. This is what I love about Lam Research. Same thing for Applied Materials, by the way. We have companies in this sector focused on growing free cash flow per share and focused on rewarding shareholders. And everything was available at a very cheap valuation. If you look at the PE ratio now, it's 30, but it was not always the case. And when I bought Lam Research, it had a very cheap valuation, I would say. if you look at the PE ratio for Lam Research, let me show you. Let me show you here. You had, I think I bought in January. When did I buy? I bought at 80, I think. 80 should be around January, maybe more, maybe February. If it's February, you had a PE ratio of 25. Fair enough. 25, 24, something like this. In April, everything dropped, and the stock was available at a PE ratio of 16, which was absolutely disgustingly cheap, I would say. And now valuation is back to being 30 again. So you have a business with a clear re-rating. Why is the stock going up? Because of all the AI investments we see. Because of Nvidia making new highs. You follow the trends. The same things are happening with ASML. ASML is a stock you own also, Gabriel. So similarly, these stocks are cyclical. ASML is cyclical, and ASML is a great company that is growing profitably, okay? Doing buybacks, they have a lot of cash. And what is really funny for this sector is people don't understand it. This is actually very funny that people complain about this company is going down, this stock's going down. I mean, come on guys, these are cyclical companies. Obviously, it won't go up in a straight line. It will go up, it will go down. And now, I mean, I'm recording this video, ASML is getting some traction, and now it is high and going up 30% year to date. And people are surprised. Oh, ASML has woken up. So ASML just woke up, and people are surprised. Why is it going up? I mean, why is it going up? I just told you so. I just told you the reason. You have companies that are thriving in this new environment, and when these stocks were cheap, it was a good moment to buy. And I did buy them. So actually, ASML is a great pick. Lam Research is a great pick. I have a lot of my students that bought ASML, and we discussed inside my coaching program ASML a lot actually. All these buying opportunities that you could see here, that you could have here, and the stock price being down prevented some people from buying ASML. Maybe I'm missing something, and it's always the same. And I want to make this kind of video to teach you one thing or two. For example, when these stocks, I mean, I will talk about ASML, it's easier. When ASML went down, but the revenue was going up, earnings was going up, were going up, free cash flow going up, people said, oh, maybe I'm missing something. Oh, you know, the Chinese Taiwan invasion risk is huge, so maybe this is what the market sees. No, not at all actually. It's just the fact that these companies are cyclical. You go by waves. And when stocks are down, people give more importance to the downside risks. And when stocks are up, people give more importance to the upside potential. It's always like this. You actually see the same thing happening for Google right now. When Google stock was down a couple of weeks ago, people only focused on the downside, and it was trading at $140. And now that Google is at all-time highs, people only focus on the growth trajectory, on the upside for Google. And this is life of the market. The markets are not efficient, guys. The markets have not been efficient for a while. As long as you have humans, as long as you have emotions involved in the stock market, the markets will not be efficient. And you will have such opportunities. Google, ASML, people highlight the Taiwan invasion risk only when the stock is down. So this is completely dumb way of operating. I think you added some commentaries for the position very well. Or maybe you are hearing a bird that just came in to the balcony. This is wonderful. Okay, fair enough. You had a few comments on each of your positions. For the leverage Nasdaq pick, gonna get absolutely flamed for this pick. No, actually, I have no opinion for ETFs. You do whatever you're with your money, but be careful if you have a market going down. You will literally cry. Lam Research, no comment. and I believe you had a comment about ASML. If China and Taiwan risks don't materialize, it's a great long-term compounder. I mean, people overestimate the Chinese risk, the Taiwan risk. This is the only thing to monitor, and it is very manageable. Even Charlie Munger said it. The late Charlie Munger had a comment about the Taiwan invasion. I'm surprised so many people obsess about the Taiwan invasion risk. I mean, this risk would even be more important for TSMC, but because TSMC is a clear customer from ASML, you will have a big impact. If China invades Taiwan, they will disrupt everything and all the chip makers will suffer heavily, but this risk has a very tiny probability of happening. Well, let's see if this ages well. I would say all the chip sector will be massively impacted if we have a war happening in Taiwan. But you have other things to monitor. I mean, ASML is still a monopoly. The competition from China is 10 years behind minimum. You have a management that is obsessed with competition and efficiency. You have a business that is growing massively, and they make sure to invest in capex for the next leg of innovation. So they invested massively in 2022 in big capex, and now they are generating a lot of free cash flow. So actually ASML is a strong buy. I don't see many risks happening for ASML. The PE ratio is in the 30s, which is warranted and deserved for a monopoly. They are a monopoly in EUV, 100% market share, 10 years ahead of competition. Minimal risk actually, minimal risk. But as always, people were scared when the stock was down. And now I'm strongly forecasting if the stock continues to go up, stocks will get more momentum and people will become more bullish and more bullish. As always, people will chase. Guess who invested here? Well, Gabriel, this subscriber, and many of my students inside the coaching program. Many of my clients invested in this one. It's a great company. BITB, next one. Oh, come on. Bitwise Bitcoin ETF beneficial interest. You know what? I have no opinion. No opinion. I don't like to invest in Bitcoin. I don't like the investment pitch in Bitcoin, but you do whatever you want with your money. You do whatever you want with me. Let me just skip it. I will never invest €1 in Bitcoin. And it's not something I like to do. Well, you have the two big boys here, Google and Meta, 5%, 5%. A good question I would have is why do you have such a low percentage of your portfolio with these magnificent companies? Do you have any comments on Google and Meta? Not at all. So yeah, why so little? Because these are one of the best businesses you can have in the world. I talked about Google and how sentiment is fragile, sentiment is weak, sentiment is strong 1 month after this. Sentiment is changing because people don't know what they are doing, literally. They are panicking and then euphoric, and panicking and then euphoric. Oh, fair enough. Give me all the shares you want. And same thing for Meta Platforms. Meta Platforms is a company that very few people hold for a long time. I first bought my first shares of Meta Platforms in 2018. So a few years ago. And I think I have seen everything with Meta Platforms. Now, stock prices that go down don't afraid me anymore. Don't scare me anymore. I've seen such a massive drawdown for Meta Platforms. I'm vaccinated. You had a 70% drawdown in 2022. It was horrendous, the kind of things we have seen. But investing in Meta Platforms has taught me a great lesson to only partner up with great management teams. Because if you have a problem with the business, if you have a turnaround play that is not showing great signs, if you have some mistakes, if there is a clear competitor like TikTok that is coming, if you have regulatory issues, a great management team will be able to turn the ship within 2 years. Which means if you make an investment and it doesn't turn around in 2 years, you have a bad management team. Be extremely harsh on grading management teams. This is the way I invest. I'm a harsh grader when it comes to management teams. And if you don't change your business for good in 2 years, you are slow. And Mark Zuckerberg has shown us investors what he is capable of. He literally changed the tone and the name of the business from Facebook to Meta Platforms. Metaverse, billions of dollars being invested, burned the cash, and the stock dropped 70%. You had some impacts from TikTok, from the ATT regulation from Apple and the cookies. And then the tone changed. He said, now we are back to our roots. We are back to being efficient. 2023 will be the year of efficiency. We want to generate cash flow again. We will fire a lot of people. We'll get efficient. We'll get lean with smaller teams. It took 1 year for Mark Zuckerberg to do this. They entered panic mode. And since then, since the bottom, it's an investment that was multiplied by 7. So yes, only partner up with great quality companies, great quality management teams. Okay, Mark Zuckerberg is one of them. I would argue Mark Zuckerberg is in my top 5 CEOs, best CEOs of the world. Yep. So obviously I love Meta Platforms and it's a buy and hold for me. And I would say buy more of this. I mean, I'm not saying this is not a recommendation to buy or sell, but why don't you buy more Google and Meta Platforms? As you know the strengths of these businesses. I would argue they have a better moat than Lam Research. They can maybe have a better moat than Amazon. And they are more efficient with better margins. And the management is as good as Andy Jassy here. I would say out of the 3 CEOs, Andy Jassy for Amazon, Sundar Pichai for Google, and Mark Zuckerberg for Meta Platforms, I would love to only focus on Mark Zuckerberg. And he's only, 41 years old? In the 40s. So you have a lot of potential. And they have such an immense runway when it comes to innovation. Meta Platforms is great actually. It's definitely a buy and hold. I've been holding Meta Platforms for 7 years now. And I will hold. And I will hold for as many years as possible. Okay, the valuation is reasonable right now. You have a PE ratio below 30 for such an exceptional business model. I just love it. They will integrate AI to do everything now. They don't have a debt problem at all. They can take on more debt to finance the capex actually. This is what I'm expecting for Meta Platforms. Please invest in the next innovation in AI, in robotics, in whatever you want. Take on more debt to fuel your to finance your big data centers. Okay, next one on the list, you have Shopify. Oh, a very interesting pick. Shopify is a Canadian company that has grown meaningfully. Okay. Too bad I don't have coffee today. I just woke up and I'm still with water because it's raining so bad I can't take a coffee outside. Anyway, we are in slow mode today, but it is fine. Thank you for being here with me. Shopify, $200 billion of market cap. You all know Shopify, e-commerce platform primarily to small, medium-sized businesses. You have 2 segments, the subscription solutions segment and the other one, physical stores, pop-up stores, social networks. The merchant solutions segment offers add-on products for the platform that facilitates e-commerce and include Shopify payments, Shopify shipping, and Shopify capital. Fair enough. To be honest, I've never really looked at Shopify because the valuation has always been very expensive for me. And if you look at Shopify, all the metrics are trending in the good direction, I would say. Do you have any commentary on Shopify? High revenue growth plus EPS play with switching costs. I would say you have economies of scale happening for Shopify, much more than switching costs. You have your business, everything related to your business linked to Shopify, and scale helps them meaningfully. But when it comes to valuation, if you look at the PE ratio for the business, first of all, they had a negative PE ratio, so they were unprofitable before. Okay, if you look at the net income, they have only been profitable in 2020, 2021, 2023, and 2024. For all the other years, they were unprofitable. To that extent, the earnings are very low. To that extent, the stock has a PE ratio of 80. This is extremely bad, and the stock is overvalued by a lot. If you take into account the price to free cash flow, you have a price to free cash flow of 100. Why would anyone invest in Shopify at these prices? It's very strange. Maybe you bought before. Maybe you bought in 2022. I hope you did. But now I don't understand why anybody would buy Shopify now. You have a growing business, yes, but at what cost? At what cost? Actually, you have other businesses that are growing at the same pace, but being profitable. So I don't see the things people see in Shopify. The free cash flow generation you have is boosted by the stock-based compensation. Like all tech companies, you have a lot of SBC, which means stock options, which means salaries to management teams. And most of the free cash flow is fake. So you have a company that is growing but not profitable without generating much free cash flow. They need to finance this growth by issuing more shares. Luckily for us, they have reduced the dilution over the years, but they don't have a debt problem. The margins will maybe improve in the future, and scale will help them to some point. What are the plans for Shopify? Do they plan to turn profitable? I mean, I know they are profitable now, but we are talking peanuts profitability now. What are their recent slides? What are their plans for the future? Do they plan to stop growing and focusing on efficiency? Because this is likely this is a likely scenario that may happen. We have seen this with other companies such as Wix.com, that for many years was focused on growth. And then they said, you know what, let us become profitable now. So instead of burning cash and growing 30% per year, the company started to turn a profit, to have a profit, but growth decelerated. So you have to choose between being a high growth company and a free cash flow machine. You can't do both. So the question for you I have, Gabriel, is do you know which path they will take on? Let me put it full screen so you can see, and let me go through some slides here. Seems like they talk about innovation, leading platform, growth, partnerships, more growth, innovation. I see no specific mention of free cash flow or margins. They want to become a giant, which they are doing. Okay. The revenue growth is great. Everybody is up and to the right. Everything is up and to the right. Since COVID, everything accelerated, I suppose. Yes. Let me scroll. I see no mention whatsoever about profitability, about margins, about gross profits. Yeah, I mean, gross margins are irrelevant. Look at the free cash flow margin. We are here. This is important. Apparently, they improved the free cash flow margin for the past 5 years, which is quite good. What can it be higher than this? It's too low. Revenue standard. The revenue is growing very rapidly. The gross margins are stable for the past 2 years. We reached our lowest quarterly operating expenses as a percentage of revenue. Yes, exactly. This is what we want to see. We want efficiency. We want to reduce costs. Okay. So they have some plans of using operating leverage to reduce costs, committing to delivering strong free cash flow margins while investing in growth opportunities. No, it will be extremely hard to do both. I don't believe companies can do both. It's very unlikely, I would say, to find a company that will grow immensely while being very profitable. It will be very, very lucky for you to find one. If I click on the comment size, let me check. So, let me show you something. You have 3 lines here. The blue line, the percentage of SG&A to revenue. How much is the cost and social SG&A, general salaries, administrative costs? What is this percentage compared to the revenue? What is great is for the past 10 years, this has gone down from 40% to now 20%. What it shows you is you don't need as many employees. The company has gotten more efficient over time. This is exactly what you want to see. So this is wonderful. The green line is how much do you reinvest? The R&D cost compared to the revenue in percentage. Well, it was 18%, 26%, back to 14%. If this is continuing to go down, to trend down, this is wonderful. This will focus on efficiency and it will improve margins. What about the SBC, stock-based compensation? So the free stock options that you give to employees, salaries. And apparently it was at 4% 10 years ago, went up to 10% during COVID, and now back to 4%. Seems like the company wants to focus on efficiency. And maybe this is the reason why margins should go up. Let me check the margins over time. Operating margins improving. For the past 10 years, in the past, the company was not profitable because of a lot of costs. And as we have just seen, the company has become more efficient with time because of economies of scale, as always, operating leverage. So you have fewer costs, less costs, and everything is improving the margins. The next question is, how high can margins go? Question for you, because I don't know this one. Regardless, what is the net profit margin of this one? Because the company doesn't have any debt, so they should be higher. They can use the cash to generate some good profits. Okay, fair enough. You have a net profit margin of 20%. In the e-commerce department, what is the most profitable business? What is the margin of the most profitable e-commerce company? Is it 20%, which means you have a cap at 20%? Or is it 30% or 40%? Maybe Shopify is the most profitable company in this industry, which means it would be very hard to grow the margins. Maybe 20% is the maximum. Now they are continuing to grow margins 23%. Even if you consider this improvement, the company is now steadily profitable. Even if you consider this, the forward valuation, the forward PE ratio is 100. Oh boy. No, I wouldn't touch this one even with a stick. Valuation is just too high. This is a great company, but the valuation is just excessively high. Excessively high. Yeah, good pick though. Good company, but I don't like it. As a stock, as an investment, I just hate it. These kind of companies are great from a customer's point of view, great. And they are moving in the right direction, I would say, up and to the right, more revenue, more leadership, more efficiency, but it's still too high. It will be a mistake to buy such companies at a high valuation. I've seen too many examples of companies that were in a similar situation, and eventually, not now, but eventually in the next 5 years, they go back to a normal valuation, and the stocks went nowhere actually. So that's the main risk I would see for Shopify. I don't see tariffs being a big risk for them actually. Next one on the list, you have SoFi, and I think you have a comment for SoFi. SoFi, this is 5% of your portfolio, user of this company, and long-term potential to capture a lot of Gen Z market. I see a lot of YouTube videos about SoFi. People are very happy about their SoFi investment because the growth is here. The data is here, and this is the new way you can get the new generation to banking. SoFi is a financial services company that was founded in 2011, and it is based in San Francisco. Initially known for its student loan refinancing business, the company has expanded its product offerings to include personal loans, credit cards, mortgages, investment accounts, banking services, and financial planning. The company intends to be a one-stop shop for its clients' finances and operates solely through its mobile app and website. Great for the new generation that is solely focusing on phones, smartphones. Through its acquisition of Galileo in 2020, the company also offers payment and account services of debit cards and digital banking. Let me say one thing first. I hate this industry. So I will not invest in SoFi because of so many competitors. I think it's very hard for anybody in this industry, in the fintech industry, to have an edge, because eventually you will have new competitors that will come and eat your lunch. So now people are celebrating about SoFi because the stock is up. But since the IPO, the stock is flat. For the past 4 years, no results whatsoever. Real believers in SoFi that went in 2021 and it invested in the company during the IPO, that believed in the company, are very sad right now, and that are not celebrating as much as some of the people that bought after. But this is a growing business. Revenue is up. The debt is manageable. The company is burning cash every year. Seems like the company has just turned profitable. Good for them. Why is the free cash flow down? You have a little bit of a dilution every year. Let me check. SoFi. From the YouTube videos I have seen, people only focus on growth, AUM, revenue. So, not real cash flow. Income statement. Why is the company not profitable? You have a revenue that is growing. Let me do this. Okay. Not revenue before provision. Let me check. Total revenue after provisions. Interest expense. Provision. Oh, fair enough. Okay. Okay. The interest expense. Maybe the company was not profitable before. They were too small in the past, and now scale, economies of scale, will help them. Maybe it is the case. Maybe let's go through the investor presentation, go through some slides and see what we have. What are the growth opportunities for SoFi? Now they are very proud of their growth. Yeah, obviously. 7th straight quarter of profitability. I just don't like this at all. I completely hate this investment because of such a little track record of profitability. If you look at my portfolio, I only invest in companies that are profitable, very profitable, and have been profitable for many, many years. So the fact that this company has been profitable for only 2 years disqualifies this investment. So From an investment perspective, I hate it from my style. But as a company, I understand why people buy it because of the growth opportunities. Maybe as a customer, it's great. I have never used SoFi for my personal experience, so I don't know as the customer's perspective. Maybe it's great. Maybe it's a revolution, but as an investment thesis for my portfolio, not for me. New records. You have a new CEO since 2018. Fair enough. And the growth in members is huge. Wow. You went from 1 million members to 10 million members in only 4 years. So this is, one platform to do everything. And the number of members are, this number is growing 50% per year. This is huge. Huge. So the Gen Z is loving it. Loving it. What's the size of this market? Can they continue to grow 50% per year for a while? You have more products. This is a company in full force. The growth is phenomenal. Yeah, I understand why people are buying SoFi, because they are seduced by these growth trajectories. Adjusted net revenue, adjusted EBITDA, adjusted net income. I don't like when you have so many adjustments in the slides. I don't like when companies mention adjusted EBITDA. Adjusted EBITDA means absolutely nothing to me. And I hate every slide that mentions adjusted EBITDA. And I want to shy away from this kind of investments that are mentioning EBITDA. EBITDA is very bad. Adjusted EBITDA is worse. Okay. Fee-based revenue. Maybe this is the reason why it is turning profitable. The net revenue is $1 billion. The fee-based revenue is $1 billion. That's the majority of their revenue. No, 40% adjusted revenue. Margins have been improving for some quarters now. And the company has just turned profitable. Tangible book value. Yeah, you have a lot of information on these slides. Net revenue, contribution and margins. SoFi members. You can have some moat here because of the stickiness of the products. It would be very hard to have a moat, but maybe they have one. Personal loans, adjusted net revenue. Let me just scroll down this. Personal loans, student loans. Is the growth driven by new loans? Net charge-offs, okay. Profitable. This is the way to just operate from the app. This is the new way of doing banking operations. So this is quite good. They are very well positioned to benefit from this new environment. Digital first, mobile first, etc. Anyway, the risk of disruption, I see it very, very high for this business. And what is the valuation? PE ratio of 50. What are the other valuation metrics for this business? P ratio of 50. Yeah, it's not that high. If the business is growing 50% per year, I can totally understand why people would buy this stock. What's the price to free cash flow? Minus 11. Which means you have negative free cash flow. Let me check the cash flow statement. You start from a net income that is positive lately. Net change in loans held for sale. Oh, fair enough. Welcome to investing in banks. This is why the banking industry is too hard for most people, because it's a mess to understand the financial statements. And bank companies will manipulate all the data they can, because they know how to do this. This is literally their job, to manipulate the data. Yeah, not for me. I don't like it at all, actually. Good luck with SoFi, but not my cup of tea. Too high a price, too high a valuation for my standards, and everything revolves about the growth. So if the growth continues, exactly like Shopify actually, if the growth continues, you are safe. If the growth slows down because of some innovation some new competitor, some new investments, some new desire to become profitable, you are dead. Let me move on to MSCI. MSCI is 5% of your portfolio. And actually, I see the stock as a quality company available at a fair price. The stock is getting punished now. The stock has gone nowhere for 5 years, only because the valuation was stretched in 2021 and went back to reality. This is the only thing that matters for MSCI. So yes, I think on my channel I have uploaded many videos about why I think MSCI is a buy right now. And some people are disappointed because they only look at the stock price and they don't understand why the stock is not moving. Well, the reason is very simple. It's valuation. Seems like fiscal AI is not working properly for the P/E ratio. So let me use stock unlock. You have discount codes, by the way, guys, to either use fiscal AI or stock unlock. You can just check my description and you have discount codes. It will be cheaper if you use my links. So if you want to use these websites, use my links. It will get cheaper for you. MSCI, let me go to freeform. Stock unlock is such a great tool. For the freeform tool, it's great. Maybe the best. This is your PE ratio for MSCI. You have a business that was trading the stock that was having a PE ratio of 30, 40, and in 2021 it reached 78. It will not continue like this. It reached 78 because at the time ESG was trending and MSCI was very well positioned to grow in case the ESG segment grows. They created a new segment, sustainability ESG segment, back in the days a few years ago. And in 2021, the ESG segment they had was growing 30, 40, 50% per year. So Wall Street expected this growth in ESG to continue to grow like this. It turns out that ESG was a fad and it faded away. So a beautiful segment that was priced in disappointed and valuation came down. The PE ratio went down from 78 to now 38. A little bit below this anyway. So yeah, this is the reason why the stock has gone nowhere for 4 years. If you look at the fundamentals of the business, apart from the ESG segment, like globally, revenue is still trending up. Net income is still trending up. The free cash flow is still trending up. They are doing buybacks almost every year. Now the company just announced, actually 1 or 2 weeks ago, a new buyback program. They are taking more debt to do more buybacks because they think they are cheap. If you look at the price to free cash flow or PE ratio or anything you want, oh, now fiscal AI is working. Wonderful. If you look at the PE ratio, price to free cash flow, we are back to normal territory. Why do I only have data for 2 years? Is it because of this? Okay. Sometimes fiscal AI is strange. Fair enough. We have the valuation multiples, PE ratio and price to free cash flow for MSCI for the past 10 years. What you see is clear. In 2021, the stock was expensive. Anyone who bought MSCI in 2022 made a huge mistake to believe ESG would grow for infinity and will become widely profitable. And it was quite sad to start a position here in 2021 at such a high multiple. A PE ratio of 80, I mean, come on. This is what I just said for SoFi or Shopify. You can have a great business model that is priced for perfection. If you buy right now at a high valuation, you will be disappointed one day or another. So maybe not next year, maybe not in 2 years, but eventually look at what is happening to MSCI. The business is still fine, growing 15% per year. Profitable, sky high margins, great management teams. They are doing buybacks every year. They are doing dividends every year. Growing in key areas of segments. Very, very profitable. But the multiples went down. And if you don't know how to do this, to value companies like this, you are doing a stupid mistake. Stupid mistake to buy at such a high multiple for everybody that bought MSCI in 2021. It was such a massive mistake actually. So the price to free cash flow went down from 60 to 30. Boom, cut in half. So was the stock cut in half? Not at all. Actually, we are down 17% from all-time highs. The difference between being cut in half and 17% is earnings went up during the time. So this is the reason. And now that we have a more reasonable valuation, I mean, let me look at the price to free cash flow. It's a better indication of the business. If I look at the average and the median, we are at 34 and 34. These are the horizontal lines here. So we are below the average for the past 10 years. We are below the median valuation for the past 10 years, which means, relatively speaking, we are cheap. And actually, another way to look at valuation for MSCI would be to look at the DCF, to just perform a DCF and see if you like what you see. Let me go to DCF here on Stock Unlock. Stock Unlock is by far the best DCF model I have used, and I've been using Stock Unlock for many years. So again, if you are not using Stock Unlock or Fiscal AI or two of these websites, you have cheaper codes in my description to start using them. You are missing out, and using Fiscal AI and Stock Unlock will save you hours and hours and hours, and you will concentrate your ideas, your research process in only two websites. This is great. The value you get for this subscription is unbelievable. I think these two websites, Stock Unlock and Fiscal AI, are extremely cheap, and it can get cheaper if you click on my links. Okay. MSCI is a company that has grown the free cash flow at a very healthy pace, I would say. If you look at the free cash flow growth rate for the past 20 years, this is the information we have. Look at this. For MSCI, the free cash flow percentage change on annual basis since 2006. What has been the average? What has been the trends over time? Average and median. The average has been a growth rate of, let's say, 19% per year. The median has been 17% per year. And look at this. Since COVID, it was 16%, 17%, 17%, 12%, 21%. What do you think will be the growth rate in the future for a business that is still thriving with very high margins? What can you put in the DCF? What is the projected growth you have for free cash flow in the future? Maybe 20%, maybe 16%. You know what? Let's be conservative, very conservative, and say 15% per year. Okay. What did we say about the buybacks for MSCI? We said they are doing buybacks almost every year, buying back 3% of their shares, 1% of their shares, 2% of their shares. They just announced that they will accelerate buybacks. So you can put 2% actually, 2% buyback yield. Let us put 0% dividend growth rate. What is a good price to free cash flow for the stock? We just saw the price to free cash flow for the business, and now we said it was at 30. The median, the average were at 34. So normally we should put 34. Just for the sake of the exercise, let us put 34. If these are your assumptions, like a normal scenario that can happen, the stock is cheap right now. And if you buy right now, you can expect a CAGR of 19% per year. If you think they deserve... Sorry, I'm dying. If you think they deserve a price to free cash flow of 30 and not 34, sorry, they can deliver a CAGR of 16% per year if you buy now, and the stock is cheap. To some extent, my dear subscriber, why aren't you buying more MSCI? Why only 5%? Why do you put the same allocation to MSCI compared to Shopify or Lam Research? Or I mean, you maybe have a better upside with MSCI. Now MSCI is getting some hate. People say the growth will decelerate. Let's see. If the growth decelerates to 12% instead of 2%, if they don't do as much buybacks as expected and they do 1% buyback, you have a CAGR of 13% if you buy now. And a CAGR of 13% means you beat the S&P 500. You outperform the market. And if you want to be super pessimistic, and if you think the price to free cash flow will go to 25, I mean, the last time we had this was in the massive problem they had in 2018 with the Chinese index inclusion. Well, it was a big problem at the time. Well, if you think these are your assumptions, you can compound at 8 to 9% per year, which is good for a bear case scenario. So actually buying MSCI right now feels very safe, and I like your pick. I would love this position to be higher on the list actually. Do you have any comments on MSCI? I don't think so. Yes. S&P Global is too predictable and I wanted more return. I have a feeling international markets will grow in the future due to many reasons. I mean, say the reasons. A feeling is not enough to base an investment idea on. So this stock is a way to invest in that without buying international index funds. Yep, the MSCI indices are international indices. So just in case international markets outperform the S&P 500, MSCI will benefit. To some extent, investing in MSCI is a way to invest in emerging markets. Europe, Asia, all these kind of things, right? So if you want to diversify your portfolio, but you still want a US-based company, MSCI is the way to go.
By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.
Next one is Novo Nordisk. Oh, okay. This will get a lot of clicks. What did you say about Novo Nordisk? Did you say something? Novo, you have a team that's really focused on diabetes and obesity market for many years. Long-term looking for duopoly with Eli Lilly, where Novo Nordisk can capture a large base of customers with oral pill. Sector is also growing extremely fast. Yeah, you will have more obese guys in the future, for sure. This is the way we do it. You have a world where people love to consume, and this trend will likely accelerate. So you will have more obese guys, and if you have a magic pill, people will take it, obviously. So this market will grow in the future. Novo Nordisk is a sad story, to be honest, because the margins are high, the management team is completely decent, the revenue is completely okay, growing nicely, the net income is okay, growing nicely, the free cash flow is okay, growing nicely. They don't have such of a massive debt problem, and they are doing buybacks. They have been doing buybacks for many years now. Actually, they took on more debt recently. We'll see if that pays out. And now the PE ratio is 15. It's a company that is having problems, and I would argue temporary problems. And they kind of fired the CEO for this reason. You can see in our analysis that sometimes we focus on quantitative things like margins, revenue growth, etc. But sometimes the analysis is qualitative. When you had a press release for the firing of the CEO, well, officially the CEO resigned. Okay, fair enough. You had many things in this report. And on several occasions during the press release, I think 4 times, they mentioned the stock price. So a reason for firing the CEO is stocks go down. So you have a board of directors that is very angry with the situation. And I think they will do everything they can to boost the stock price. Novo Nordisk is a darling from Denmark. That's the biggest component in their index, right? How much is the weighing in this index? How can Novo Nordisk weighing Denmark index? I don't know what's the name of the 40%. So, wow, this is crazy. Novo Nordisk is 40% of the Danish stock market. So they don't want to destroy their crown jewel, as we say. Can we have an updated information? What's this date? End of August. Oh, this is fine. Novo Nordisk, even after the drop, is 47% of the index. Unbelievable. A Nordics country that is doing this. This is unbelievable. It's very likely that Novo Nordisk rebounds. I'm not an expert about this industry, and I don't think I know enough to start a position, but I like that you invest in this one, so congrats. It's getting a lot of hate, and they announced some new drugs development with a percentage of a win rate, how much weight do you lose when you have this pill, and you compare this with Eli Lilly, and it turns out that Eli Lilly has been over-promising and under-delivering, so the stock went down and then went up, and then you have Hims that is coming to save the day, but Hims and Hers turns out that they only had some market share because of a temporary issue in this industry, so the moat for Hims is very narrow, I would say. People love Hims at the moment, flows are moving, everything is temporary in this industry. I would say Eli Lilly and Novo Nordisk, they have a good chance of staying a duopoly in the future. For the moment, we don't have enough evidence that Hims will enter the market for good. For the moment, Hims is enjoying a temporary run, regulatory-wise. And if you don't know what I'm talking about, please do some research if you are investors in these stocks, because it's all about regulation for this industry. So yeah, I like Novo Nordisk actually. I would say this is one of your best investments you have in your portfolio. Novo Nordisk, literally this is the golden kind of opportunities we can dream of. A good business, duopoly, the CEO is getting fired, people are angry because stocks go down. The country will eventually save this company. They will find a new way of creating shareholder returns. The valuation is completely okay. Same thing for United Health. Many temporary problems, but you need this kind of companies. You need United Health. You need Novo Nordisk. You need Eli Lilly. Actually, I have one of my students that had Eli Lilly and did an arbitrage play to short this one and buy Novo Nordisk. Pretty interesting. Eli Lilly at the same time is running at a higher valuation, double the valuation as Novo Nordisk. So yeah, we'll see how it goes, but this one is good. Uber, I will not make friends with Uber, unfortunately. I don't like Uber as an investment thesis. I don't think Uber has a moat, and I think this will age poorly. I think my comment will age poorly because so far the management team has been exemplary. But I just don't find Uber to be a quality compounder that has a moat, and I don't see the future for the next 10 years for Uber. Strangely enough, I see competition coming. I see as a customer's perspective, they don't have an edge. They literally don't have an edge from a customer's perspective. And at the end of the day, you want customers' stickiness. Now you have so many alternatives for taking a taxi. In the past, you had Uber and you only had Uber and the taxi, and Uber was way cheaper than taking a taxi, and he can pick you up from home, so it's great. But now prices have gone up from Uber and competition is coming. You have Lyft, you have Bolt, you have Grab, you have many, many other competitors that are coming. What is Uber doing? They are increasing their prices, and increasing the prices also for Uber Eats, the service fee, the delivery fee. So now the fees are very high. So the company has just turned profitable. Only because of this, they have a little bit of scale and they are increasing their prices over time. And so far, it is working. So this is why I say I will not make friends with my take on Uber. A lot of people like Uber. Bill Ackman is investing in Uber. Dara is you have a great management team. Plenty of people that are liking Uber at the moment. Plenty of quality investors liking Uber at this moment. I'm not on their team. I just don't like Uber as an investment analysis. And yeah, I don't like your pick at all about Uber. It doesn't make sense. Either you choose MSCI that is safe and reliable, or Uber that just turned profitable with a lot of competition. You have to choose your side. Having a portfolio means you have to make a basket of stocks. The good question to ask is, what is your style of investing? A little bit of Bitcoin, a little bit of leveraged Nasdaq stuff, a little bit of Palantir and SoFi, and you ride the wave. But at the same time, you have a value investing play with Novo Nordisk, MSCI, Lam Research. What kind of investor are you, Gabriel? What kind of investor are you? I don't like Uber. It's been unprofitable for so many years. The reason they are now generating free cash flow is a little bit of scale and increasing their fees, which I believe is not a good way to raise prices. Okay, so in the short term, they will do fine. The valuation is fine. They can continue to grow their free cash flow by a good amount. But for a long-term investment, I don't like it at all. Next point on the list, NVR. Oh, now we are talking about safe, reliable investing that can safely compound. And I love it. I love NVR. And I think it's one of the best Uber cannibals that you can find. Meaning they are heavy repurchasers of their own stocks. They do buybacks every year. And they are generating free cash flow every year. It's a company. It's a home builder. It's a home builder that went bankrupt in the 90s and that resurrected like a phoenix, saying we don't ever want to go bankrupt again. We want to be very efficient, very lean. We want to be asset light. So instead of buying the lands outright and then developing a new house, build a new house, they buy an option, like 10% of the price of the land, an option on the land. And they only exercise this option. They only buy the land if and only if you have a buyer that will build the house. So this method is very asset light, which is the reason why they have spectacular margins compared to other home builders in the US. And this is the reason why they can grow so nicely with very fat margins. They don't need debt to grow. They are net cash. They are generating huge free cash flow every year. And they are using all this free cash flow to do buybacks. And over the past 20 years, they have repurchased a lot of their shares. Even since COVID, they are repurchasers of their own shares. Strangely enough, they diluted their shareholders for only 2 years, 1%. And then they did a buyback. In 2021, they repurchased 6% of their shares. In 2022, 6% of their shares. 2023, 4%. 2024, 6% of their shares. So what is the good valuation for such a big home builder? I would say now it's a little bit expensive. You have a PE ratio of 17. It was literally a PE ratio of 10 in 2022. Look at this. I can go to Fiscal AI. Fiscal AI, NVR, and I want to go to ratios. Come on, ratio, trailing ratio, PE ratio. This is what we have. This is not a stock that will trade at a PE ratio of 30. In 2022, PE ratio of 9. Gabriel, did you buy NVR in 2022? And for all the people that did not buy NVR in 2022, what were you doing? I hope you were buying other things that went up. P ratio of 9, and then it went up to P ratio of 20, back down to 14 and now at 17. It's a great buy and hold. I love it. It's a tiny bit expensive right now, but it's a great buy and hold that will compound, but it will be cyclical depending on the real estate industry. Cash heavy, asset light, major buyback. I love it. Tesla. I will be very fast. I will never invest $1 in Tesla. I don't like the company. They have a genius CEO that you can't really trust when it comes to projections. Elon Musk is known for over-promising and never delivering. Think of all the robo-taxis claim we have had for so many years. It will come next year. No. It will come, next year. No. Next year. No. Just never happening. And at the same time, I see what is happening in China. I see what is happening in Asia overall. And electric cars have now become very competitive. We'll see how it goes. Now, because Elon Musk is a genius, people will always find something to be bullish on. It will be robotaxis. It will be robotics, humanoids. Yeah, this is just not the way I invest. And also, Gabriel, how do you invest? This is a speculative bet. Frankly, this is a speculative bet at a PE ratio of 200. So you are betting on a CEO that is not known to be reliable, absolute genius, maybe the second wealthiest guy in the world, maybe the top one actually, that has little incentives to continue working on Tesla, that is changing his mind about the government, maybe working full-time jobs in the government and then going back to Tesla. Maybe he will change some things. Many companies at the same time, creating wonderful shareholder value to shareholders and then disappearing for some years. And now it has become more competitive to be in the automotive market, a car maker. So yes, they have the distribution, they have the vertical integration. I'm aware of all the bullish signs people see on Tesla. But are you willing to pay a PE ratio of 100? PE ratio of 200 for this kind of stock? For the first time ever, you have a decline in revenue. You have a decline in shipments in cars, which is very bad. The company is not profitable. You have fake numbers. I have an accounting degree. I have a master's degree in accounting. So my literal background is based on how do you find good businesses? How do you spot if a company is lying to you? How can you see if a company is honest or dishonest? And the case study we have seen at school was Tesla, was Twitter, was Snapchat. How can you manipulate data to look appealing, but actually this is a entertainment show for us accounting guys? How can you manipulate the data? Tesla is a case in point. And I will not make a video about this because I don't want to get bad comments. Be very careful investing in Tesla, I would say. Be very careful investing in Tesla. You have a lot of risks that are hidden. And you will not find many videos talking about accounting problems in Tesla actually. Because nobody does the work. Like the accounting work you need to do to really understand how the engine is working. Regulatory wise, subsidies wise, you have plenty of things happening at the same time. Next one. Fortinet, 4% of your portfolio. I suspect it's a recent buy for you. Fortinet, what did you say? Lack of deep understanding in this sector. Okay. But strong buybacks and sector tailwinds. The cybersecurity sector, yes. Plus opportunity to raise prices because of switching costs gives a moat. Plus revenue and earnings per share numbers are strong. I wanted a solid cybersecurity play, and I agreed with you in your thesis. The other players in this space command very high valuations. Actually, we just learned yesterday that CrowdStrike was having an investor day and they guided for 20% growth for the next 5 years because they will invest massively in AI. And the stock was up 12% yesterday. if you look at the valuation for CrowdStrike, you may fall off your chair. The company has a PE ratio of... Oh, you have a negative PE ratio right now. 700. Okay, let me check the price to free cash flow. It's a better indicator for this industry. You have a price to free cash flow of 80. Very high, very, very, very high. So Fortinet is a company in the cybersecurity industry. I've made plenty of videos about Fortinet if you want to deep dive on this company. And I'm following very heavily. This is the stock that I have bought recently. So I will be biased, obviously, and I will tell you that I love the stock. This is not the first time I am buying Fortinet. I was a shareholder 5 years ago, made a fortune out of the stock actually, and I'm back to it. I sold at the top, went back now, and let's see how it goes. And I want the stock to go down actually. I don't want the stock to rebound now. I want the stock to go down. I want the stock to go down meaningfully. I want them to miss badly for the next earnings report, so I can make it a huge position. I'm a big believer in Fortinet, and regardless of what everybody is saying about the slow growth, Fortinet has never been about growth. If you look at the past history of all the CFOs of the company, for the past 20 years, they have changed the CFOs for 4 times, 5 times. Every time, the CFO was not focused on growing more. Every time, the CFO was not focused on M&A. The key thing that I would say gathers all the CFOs of the company are... The key thing is efficiency, margins and efficiency, and returning the value to shareholders. So literally Fortinet is in the cybersecurity industry, but is in a different category from the other guys that are focused on growth and M&A and leadership and market share, etc., etc. So Fortinet is in a different category, focusing on margins and buybacks. Guess what? A few weeks ago, they have announced a new buyback program because they think the stock is cheap, and I agree with them. If you look at the price to free cash flow, we are back at reasonable territory. I bought the stock with the price to free cash flow of 28, meaning, and actually you can even look at another metric called the EV to free cash flow. It's the price to free cash flow, but you take into account the cash. And actually, I first bought Fortinet at an EV to free cash flow of 20 in 2020. And I sold at the top here at 45. It was a quick triple of my investment, actually. I sold at the top. And I waited and waited and waited. And the stock went up to an expensive valuation. And now the stock is back down to EV to free cash flow of 26. I think the stock is fairly valued now. I don't think the stock is cheap, but I think it will do wonderful if you invest now. Because even though the company is not focused on growth, they are positioned in an industry, the cybersecurity industry, that can grow at 10% per year, 12% per year. And every time, Fortinet has grown above the growth rate of the industry. So you have a company that will grow minimum 12% per year, but their focus is not growth. Their focus is buybacks. The focus is efficiency and margins, which I love. And I suspect you are following me into this trade, and you want to increase your position as the stock goes down because you have been following my videos with such diligence. I have a position personally on Fortinet out of 5% of my portfolio, and I want to increase it to 10 or even more as it drops. And I suppose you will do the same. Next one, ASML. We already talked about ASML. Envox. Is it something about pharmacy? I don't know this company. Oh, no, that's an index. It's long Novo Nordisk with leverage. Oh, wow. This is exactly what I said earlier. The risks of investing in leverage. Tell me you are 22 years old without telling me you are 22 years old. Investing with leverage will give you a lot of upside if you are right, and will destroy you, absolutely destroy you if you are wrong. This is something you don't want to do, actually. Well, it shows us you have a lot of conviction when it comes to Novo Nordisk and you think it will rebound. But what if you are wrong? What if it never rebounds? What if they have problems and problems and problems, exactly like we have for Evolution AB? Like things should go right, but it's been problems and problems and problems. They're never going the right direction. Maybe this thing will happen. When will Novo Nordisk rebound? Nobody knows. Nobody knows. It's a value play, but what if you are wrong? I don't like the investment in leverage. Do you have any comments on this? Short-term, medium-term play. Yeah, hope for you will sell. ELF. You have ELF. Do you have any comments on ELF? I don't think so. I have a doubt. ELF. By the way, guys, I hope you like this kind of format. It's pure freestyle. And actually, I like it. I just woke up, no coffee, just raw to the game for Gabriel. I don't have any comments. NVR buyback machine in hurt sector. Yeah, not so much actually. Where is ELF? Short-term play, medium play. Well, ELF. Oh, did I skip Landbridge? Oh, let me talk about ELF first. ELF in a shelf, as you say. You have a famous YouTuber, Jeremy Lefebvre, from Financial Education, that helped me a lot for so many years of free content and inspired me a lot to make this channel actually. I mean, please subscribe to Financial Education. It's a great channel that will help a lot of retail investors. This is great. And I did not like his investment in ELF. I mean, it's about beauty, cosmetic, and I'm not comfortable buying this. Same thing with Ulta Beauty. I'm just not a fan of this sector at all. I don't understand this sector at all. I never bought these kind of things. I never had a girlfriend that loved cosmetics. I only had natural girlfriends that were never a fan of buying into this industry. So, to some extent, you can say I'm just a chill guy. So I don't understand this industry at all. I don't understand the growth prospects in the future. I never entered the store. I never discussed with somebody that entered the store. I don't know at all. It's a short-term play for you, good for you, but not at all actually. I will never touch this one. Out of my circle of competence, I have no opinion on ELF in a shelf. But so far, the financials look good. Revenue is increasing. You have a strong acceleration. Net income is increasing. Debt is increasing. Why is the stock-based composition so high? Good question for you, Gabriel. Please do the work. Why is the SBC so high? Do you have incentives for the salespeople to acquire new customers? Like every time you have a salesman that is getting a new customer, they have free stock options. Maybe this is the reason why the stock-based composition is so high, meaning you give stock options to employees as a reward if they get new customers. Maybe this is the reason. So I suppose the free cash flow is fake because of the SBC. Be careful. Yeah, I suppose you have some fake numbers here. And they are diluting their shareholders every year. Yeah, you have a couple of red flags. The forward PE ratio is 40. So it's definitely not cheap. No clear opinion on this one. Another investment you have is Landbridge, and we are coming back to the end of this video. We are coming to the end, and I will take a coffee now. Landbridge, because it has stopped raining a little bit. Landbridge is a company I love, and it's 4 or 5% of my portfolio. As a starting position, it's an edge for TPL. Landbridge, I like TPL, meaning Texas Pacific Land, that's another company, and almost view this as a call option on TPL stock due to their small market cap and really low expectations. Actually, the expectations are huge for Landbridge, so please double check what you are saying. TPL is more mature and well known, and you explaining this business felt like finding a toll booth type business early on. Yeah, thank you for subscribing to this quality channel, quality investing channel. This is what we do. I just fill my portfolio with quality companies, and Landbridge is literally a toll gate on the Permian Basin, similarly to TPL. TPL means Texas Pacific Land. For anyone watching this video, if you don't know what TPL is, that's this business. Market cap of $20 billion. I have invested in TPL in 2020 when nobody wanted to invest in this one, and I sold at the top and made almost a 10x on the stock. So made a fortune out of TPL. And there is a little brother called Landbridge that IPO'd recently. Similarly, they own lands in Texas. Similarly, you have some drilling operations over there. The focus for Landbridge is water. The focus for TPL is oil. So that's the first difference. Second difference between the two businesses is TPL is mature, more than 100 years old. Landbridge is very new, was created in 2021. Third difference, TPL was a trust before, and now since 2021 it was a Delaware C Corp, okay? And Landbridge is a company managed by private equity, hungry sharks, as you can say, managed to boost shareholder returns, get more debt, get more deals. Which brings me to the fourth difference. TPL is known for being relaxed, hands off. You do nothing. You get the cash because you are a royalty business, because all majors want to drill oil. So you say, okay, but give me your percentage of your revenue. And you do nothing with this cash. You don't reinvest much. You just pay dividends and reward shareholders with buybacks. Landbridge is aggressive, led by private equity. They are raising debt to make acquisitions of new lands. They are much more aggressive. They want to attract customers. They want to hunt for customers. The growth rate is much higher than TPL. So the philosophy of these two investments are very different. But one thing is common. Management is a risk. TPL is known for having a terrible management team. I hope they will not watch this video, and I don't think they will watch the video, so I can say whatever I want. Who watches my channel? We are a small channel, and I love it this way. You had terrifying stuff that was released to the public in recent years for TPL. I won't go into too much details, but this is horrible when it comes to capital allocation, vision, mindset. They just want to get their salary, sky high salary, stock options, mess with shareholders. They don't like their shareholders. The management team is horrible for TPL. But luckily for us, the business is so good that even with the horrible management team, the business is thriving. The shareholders are very happy. This is the power of businesses. You can't say the same about many businesses, actually, many stocks. For example, if, I don't know, Google had a horrible management team, like horrible 0 out of 10, Google stock will tumble and the company will fall down. If Oracle had a mediocre, bad management team, if Amazon had a horrible CEO, they would not succeed. If Shopify, SoFi, Uber, if they all had a horrible CEO, they would die. But TPL is so strong. They have such a wide moat. They have such strong assets that people want, that they don't care. They will do anything and the business will just be fine. This is what I love about TPL. You don't need to be a genius to run operations. You don't need a lot of employees, and there are not a lot of employees. So the only thing I want to monitor for TPL is the valuation. You just want to buy when it's low, when it's cheap, and you want to sell when it is expensive. So the situation is very different for Landbridge. The management is much more aligned. They want to grow. They want to make acquisitions. The management team is quite good, actually, to deliver value. You have a private equity structure, WaterBridge, 5 Points, PowerBridge, Landbridge. You have a huge conflict of interest, by the way, because the CEO of Landbridge is the same as the CEO for WaterBridge. This is another public company. You have the same CEO for two public companies, and the two public companies work together. So you have a clear conflict of interests. You have the chairman, David Capobianco, that is managing 5 Point Holdings, that is managing everything. and maybe they will manipulate some data, maybe they can cheat, maybe they can play around with subsidies, because this is a private equity structure, so you can move funds and record this as revenue. So you have many questions when it comes to the management team, and this is why I say it's a common point between TPL and Landbridge. The management team is very important. You have to monitor this. You have to see what is happening, because you have some yellow flags, red flags, let's call it this way, red flags for both management teams. Conflicts of interest are huge. For Landbridge, for example, they are in talks of welcoming a data center project, and this data center company paid $8 million just in case, like a backlog, just in case you develop and you build this data center. Guess what Landbridge did? They just recorded this 8 million instead of locking the $8 million and integrating it as revenue when the project is built. No, they took on the $8 million. They took the $8 million immediately and recorded it immediately as revenue, which is wrong. As I told you, we have seen these kind of exercises in my master's degree in accounting. We have seen this, and it is clear manipulation. To some extent, Landbridge is not 100% honest with their shareholders. To some extent, you have some conflicts of interests. To some extent, you have some red flags. Welcome to adult world, adult life, investing world. The world is not perfect. You have some companies that are great, and you have some red flags. What do you do with that information? Do you completely sell out of the position? My guess is no, because the company is so great. Similarly to TPL, the assets they have are so strong that they will continue to thrive. And if you believe in the thesis of more water that is needed, more drilling, more operation, more data center that will need more electricity, more infrastructure in the US, more development in the Permian Basin, TPL and Landbridge will be fine. And the reason you are invested in Landbridge and not TPL, I suppose, it's because Landbridge is cheaper than TPL. You should have a price to free cash flow of 35, something like this. Grow Focus is wrong. They don't account for all the Class A shares, Class B shares. So Grow Focus has wrong data. The price to free cash flow is not 27. It's more than this. So, but it's lower than 40. So you should have, for my estimates, a price to free cash flow around 35. So you have a quality business with a wide moat that has the potential to be a multi-bagger in the future, with a price to free cash flow of 35. Even if you account for some risks, red flags that I just highlighted, the stock is a deal. And now you may say, but the stock is down. And what did I tell you? I told you that Landbridge is very similar to TPL. Look at the stock price of Landbridge right now. Please memorize it. And look at the stock price of TPL. Oh, it was the past 1 year. Please remember this 1 year chart, and remember this 1 year chart of TPL. You have exactly the same charts. You have a strong correlation between TPL and Landbridge. And as I told you, I sold at the top, and the stock has been trending down since last November for TPL. And Landbridge has followed the same thing. Since November, trending down. You have a strong correlation, but Landbridge is growing more. This is what I have to say about Landbridge. HIMS. We have already talked about this industry. I think the advantage that HIMS had were only temporary. Now the valuation is very high, and I see a lot of optimism around the company actually. Maybe you have seen such posts saying that HIMS will be a 100x from there. The potential is huge for HIMS. If you consider this to be the truth, it means you assume a lot of things, a lot of assumptions, a lot of things have to go right. And I don't like this kind of investing where you think that a lot of things have to go right. So I don't like the investment in HIMS. It's a profitable business so far, but it's only been 1 year of profitability. The rest have been losses. And regulatory-wise, they have a huge burden. They have a huge problem that will come eventually, in a few quarters actually. And then you have two starting positions. I will not speak too much about this one. Cava Group, 1% of your portfolio. Very, very small size of the portfolio. And this is a company that is doing it's a chain of restaurants. $7 billion of market cap. Margins are decent for restaurant business. Why did you choose Cava? Do you have a commentary on this? Because I don't see why anyone would invest in Cava with their own consent, actually. It's very strange. No comments. Fair enough. I don't like the restaurants industry. And now in this inflationary world, restaurants will suffer a lot. Please look at the costs and please look at the margins deteriorating for the next quarters because it will happen. The valuation is high. PE ratio of 50, 90, price to free cash flow of 100. What are you doing? And come on. How can you fill your portfolio with MSCI, Fortinet, Amazon, Google, and Cava? I mean, come on. You have stocks that you can eliminate from your portfolio. UNGH. Is this linked to United Homes? Did you UNHG? Is this like a leverage call of or is that's a leverage for United Health. You love leverage, don't you? Yeah, United Health has temporary problems. It's another value play that is very similar to Novo Nordisk, as we said previously. The stock is cheap and they will have a very difficult 2025, very difficult 2026, but after that they are fine. So they will have to pay fines, they will have to take headwinds, but the business will eventually be fine. I think the stock is very cheap right now. For value investors, that's great. And I understand why people would buy United Health now. I don't want to buy it because it's not quality and I prefer other things at current prices. But I understand why people would buy United Health. The next question is why do you take margin leverage to buy this? It's a stock that can continue to go down. The last position on your portfolio is DraftKings. By the way, guys, if you like this format, please leave a like. I don't know how long this video is, but it's long. I need my coffee bad now. It's a long video. Please subscribe, leave a like, leave a comment in the comment section below. I always love to read you guys. This is DraftKings. Well, all know DraftKings. Is it like a casino, sports betting stuff, daily fantasy sports, sports wagering, sports betting? Okay. Why did you choose this one? Do you have any rationale here? Speculative play. Okay, fair enough. Is the company growing? Yes. Is the company profitable? No. Is the company having a debt issue? That's okay. Is the company running for the benefit of shareholders or for management team? Good question for you. You will need to ask. You only see stock-based compensation and you see the net income. This is the same chart that is giving me nightmares for Snapchat. Every year, the company is having losses. And every year, the management is enjoying nice stock options, nice incentives, nice bonuses. What a messy situation to be in. This is a company that is run for the benefit of the management team, not for the benefit of shareholders. This is also why I love Fortinet. It is run for the benefits of shareholders and only shareholders, not the management team. Why? Because for Fortinet, the management team is, that's the two brothers. They own 15% of the company. You have balloons now. 15% of the company. So they don't need stock options. They just, if the stock price goes up, they will go up eventually. The wealth will go up. So DraftKings is a company that is diluting their shareholders. I just hate it. Let me just skip it and let me end this video. I just don't like it at all. It's a speculative play. Good luck with that. Okay, I think I covered everything here. What format you say? Thank you for sharing your video. You have a lot, sharing your portfolio. You have a lot of courage to show this publicly, show your name, etc. So this is great. I mean, you are 22 years old. You can have mistakes. You can have the time to make mistakes. You have plenty of stocks in your portfolio that go in different routes, I would say, different paths. Either the stable, resilient, profitable companies, other that are purely based on growth without being profitable, other that are pure speculation, and others that are using margins. I would hate for you to use leverage, be hooked, be addicted to leverage, and now you are 22, but when you will be 26, when you will be 25, 26, you will maybe use more leverage because you think markets only go up. This is such a great mistake to make. This is horrible, actually, a huge mistake. If you remember well, Warren Buffett was working with Charlie Munger, and you had a third associate called Rick Guerin. And I want to end this video with that. Nobody knows Rick Guerin because he was a great investor, but he used leverage. And when stocks went up, he made a fortune. And then you had a stock crash, and the performance evaporated. The use of leverage destroyed the track record, even though he was working with, not for, with Warren Buffett and Charlie Munger. So you think that you know more than the rest of the market, and you think that you are smart using leverage. Good luck. If Rick Guerin has crashed, you can crash too. And if you really know what you're doing, you don't need leverage to outperform the market. I have never used leverage and I have generated 25% per year for almost a decade. You don't need leverage to outperform and beat everybody, to outperform Wall Street, to outperform the S&P 500, to outperform indices. You don't need leverage to be good. If you know what you're doing, I mean, you have great stocks here in this list. You can cut some positions that are more speculative, as you rightly said, and be very careful with leverage. This is all I have to say about your portfolio. Bye-bye.
If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.